This video is going to talk about investment banks. They've been in the press a lot recently. There's talk about banking bonuses, how big they should be, how do they afford them. So this time we're going to take a look at what investment banks actually claim to do that justifies paying all that money to their star traders and so on. Okay, so where do investment banks fit in? Well, these days it's relatively uncommon to have an organisation that is purely an investment bank. There are some around, but many are bolted on the side of retail banks. So when you look at an organisation such as Barclays, you're actually looking at a global organisation that comprises a number of different divisions. So what you can do quite often is take a bank and, in very simple terms, split it down into two basic functions. And there's been a lot of talk in the media recently about whether banks should do both of these functions. There's retail banking and there's investment banking. Now, it is possible to get banks that just do one or the other. Goldman Sachs is largely an investment bank, as is JP Morgan, but the likes of Barclays, HSBC actually do both. They didn't always, but these days they do both. So first of all, before we look at this one, what's the difference? Well, retail banking is the bread and butter of banking in many ways. This is organising mortgages and loans for retail investors, businesses and the like, and also organising savings accounts for people with spare cash. So on the one side, retail banks take money in from investors who've got capital that they want to leave safely tucked away in a bank for a while, and they also lend it out to people wanting loans and mortgages. And ideally over here, in simple terms, you want to give away, as a bank, less to your savers than you grab from your borrowers. That way you make a profit. However, that's often seen as a little bit low risk, a little bit unsexy, albeit it's fairly safe, solid cash flow generating business. So investment banking is often perceived as the higher risk, sexy bit of the industry. And this is where the much higher margins are made. There is much more money potentially in investment banking, but there are risks associated with it. So in this video, we're going to steer away from retail banking and take a look at investment banking. And we're going to look at 5 basic bread and butter activities that many investment banks would claim sit at the heart of what they do and justify some of those big bonuses being paid at the moment. Whether or not they do justify the bonuses is another question for another video, but nonetheless it's these activities that tend to attract all the headlines. So what are they? Let's take a look at 5. So, in investment banking, and that's where we're going to focus right now, we'll leave retail banking to one side. Activity number 1, prop or proprietary trading. Prop or proprietary trading. Now, just like I can take my own money out of my own bank account and gamble it on the horses, spread betting, investing in shares, property, whatever I like, investment banks can do the same. They have their own funds. They also raise money from investors, of course, but they have their own funds, and those can be gambled, often in spectacular amounts, to make the bank money. So banks employ teams of traders to bet on currencies, commodities, bonds, and so forth. And if they get it right, they make money, like any good gambler would. Their aim is to employ the best gamblers in the market, if you like, and therefore outwit everybody else trying to do the same thing. And that activity, gambling the bank's money in order to make money, is known as proprietary trading. The second activity, market making. As a retail investor, or as any investor, if you want to go out and buy Tesco shares, for example, you need a market. And that market is provided by organisations such as the London Stock Exchange. But a market needs buyers and sellers, otherwise it doesn't work. So if I want to buy 10,000 Tesco shares, I need to be pretty sure that if I go to a market, such as an exchange, there'll be someone willing to sell at least that many shares, otherwise there's no market. I might as well just hunt around for my own seller. So market making is an important function of investment banks. What investment banks often commit to do at the London Stock Exchange is trade regularly so that other people can too. They literally make the market. A bit like if I wanted to buy a second-hand car this morning, I could run around trying to find an individual seller, or I could approach a second-hand car dealer. That is somebody who holds a stock of second-hand cars and is always willing to do a trade in them for my benefit as a customer or a punter. Of course, they're not a charity. They try to make money out of it, but market making at a stock exchange is another important function of an investment bank. It's often not terribly profitable, and it's not to be confused with prop trading because they are subject to rules about the size of bid-offer spreads, and there's also quite big competition. So there might be a dozen banks all competing to make a market in a particular share at the London Stock Exchange, and that competition can narrow spreads right down. Nonetheless, quite an important function, and quite a few banks like to be seen to be acting as market makers. It's a kind of prestigious, good PR thing to do. Number 3, M&A, or M&A advisory. Mergers and acquisitions. The people actually doing the deals, merging with each other or buying each other, are usually companies. So you might find that in the airline industry, you have one company merging with another or taking over another, for example. The banks make a decent fee out of advising those companies. So a predator, as they're known, might want to buy a target. It might approach a Goldman Sachs, for example, and say, right, we need some advice. We need some advice on the timing. When should we go for the deal? We need some advice on how to structure it. Is it going to be a cash deal? Are we going to try and buy using something else? We need some help with the regulators. What are the documents we need to get sorted out? We need some help screening the target, due diligence as it's called, making sure we know what we're buying, and so on. We also need some help publicising it. So all of those jobs you can parcel off to an investment bank, and they generally take a cut of the size of the deal, if you like. So the bigger the deal, the more the bank will earn. They also do something else, which is similar in a way, but I'm going to call corporate events. In particular, new issues. Another reason a bank might be approached by a company is it needs to raise funds. Now, it could be raising funds to fund the takeover of another company, but it might not be. A company such as Tesco or Marks & Spencer's might simply need to raise more capital. So they might decide to issue shares or bonds, depending on whether they want to issue debt or equity. And again, a bank can help. And the bank can help in a number of ways with, say, a share issue. Number 1, when should the company looking to raise the funds do it? There are good times, there are bad times. Depends on the market, depends on which investors the bank can find to buy these shares. Number 2, how do I market and publicise this new issue? Who are we going to sell these shares to on behalf of Tesco? So the bank might do a little roadshow, go around approaching institutions such as pension funds, likely investors, on behalf of the company trying to sell the shares. And that takes a bit of time. It might prepare prospectuses to market the whole thing. It might then advise on the price. It might even get involved in underwriting. It's all very well for a company to say, we want to raise X many £million and we want to do it within a month. But what if no one wants to buy the shares? Bit of a problem. If you're an airline and you've committed to buy a certain number of aircraft, you've got to have the funds ready. So an investment bank might take a hefty fee for committing to buy shares that other investors don't want in a new issue. And quite often the fee is a percentage of the amount raised. So you can imagine where hundreds of millions of pounds are involved, that fee gets big pretty quickly. So these two things, often an advisory role, but the underwriting element brings some risk to the investment bank, hence, in theory, the big fees that they charge. And then another big area is structuring products. Again, it's a sort of advisory role. Here, you get clients of the investment bank, institutional or even retail represented by, for example, another bank, coming along and saying, we need a product. We want to sell something to the public or to institutions that does a particular job, and they'll bring in an investment bank to help them design it. So, for example, you may have come across those products. At MoneyWeek, we're not desperately keen on them, called structured products that say things like, as an investor, give us your money for 2 years. In a worst case scenario, you get your money back in 2 years' time. In a best case, you get your money back and 80% of the rise in the FTSE 100 over the next 2 years. As an investor, you might think, well, that's good. So the worst thing is I get my money back in 2 years, and I might get my money back plus 80% of the rise in the FTSE. Now, the bank that sells you that is selling you a structured product. They've had to put together 2 or 3 different securities to make that work. And that's something that investment banks get involved in too. And just in case you're thinking, what is wrong with that product? Have a think about it. If I say to you, in a worst case scenario, you'll get your money back in 2 years' time, that's not great. Because over the next 2 years, you could be earning interest on your cash for simply putting it in a bank account. So just getting it back in 2 years' time isn't fabulous. And if you think the FTSE is going to rise over the next 2 years, why on earth would you only want 80% of the gain in the FTSE when you might as well take 100%? Anyway, structured products have their fans. At MoneyWeek, we're often not amongst them, but nonetheless, investment banks are quite good at designing those products, whether ultimately the target is the retail market or the sort of institutional market that involves pension funds and life assurance companies. So, lots of different activities. Does it all justify the big bonuses? Frankly, very good question, which I won't attempt to address here. But nonetheless, investment banks would say these are risky activities that should command big fees to the people directly involved in them. And although investment banks do other things, and you won't always find all of them agreeing on the terminology I've used here, these are 5 of the biggest and most common ways that a lot of them try to make money.